Task Us On Air presents CX plus U.
Hey everyone, thanks so much for tuning in to Task Us On Air. I'm Jackie Lineberger, Director of FinTech.
And welcome to CX plus U, the most ridiculously refreshing podcast on all things outsourcing. Today, we are joined by our experts, Pragya Agarwal, who's VP of Risk and Response, and Surekha Nagpal, who's Senior Director of Risk and Response. These two are the Task Us resident experts when it comes to all things fraud and transaction monitoring.
Today, we're focused on the world of finance and more specifically AML and KYC. What is that, you ask? Anti-money laundering and know your customer.
Pragya and Surekha, why don't you give a quick introduction and maybe we can start diving into these topics.
Hi, everyone. I'm Pragya, VP of Risk and Response at Task Us, which is our financial crime compliance practice. I've been in this space and industry for 2 decades now, and happy to be here and share my thoughts on this very interesting topic.
Hi, everyone. This is Surekha. Thank you, Kyle and Jackie, for hosting us. I really look forward to the discussion today. I'm a senior director at the Risk and Response team. I'm CAM certified. I have about 20 years of work experience overall in financial crime operations, project management, and business excellence. So looking forward to this, juicy discussion today.
What is AML and KYC?
Okay. So what is it, right? Both these terms, AML and KYC, sound like an alphabetical mishmash or like a tongue twister of sorts, but they're essentially the lock and key to the world of secure finance. So think of it as, a detective series where AML is like the Sherlock Holmes of tracking suspicious transactions, hunting down the money trail. And KYC is really, the Watson who verifies the identity of each player to know who is behind this financial mask. So essentially, both are indispensable safeguards for transparent and secure financial systems, right? Both AML and KYC are policies that are governed by regulatory bodies around the world that establish the guidelines and rules to ensure that, financial institutions implement an effective AML and KYC policy and procedures. These regulations can be really vast and varied based on jurisdictions, countries, the kind of products and services that are offered. So it's important to understand what are the rules and where do they apply. Then appointing a compliance officer, I think this becomes very important to designate an individual or a team that ensures that there's adherence to these regulations. Then conducting due diligence, depending on what the risk rating of a particular customer type or a set of customers is. This involves like verifying the identity of customers, assessing their nature of business, and understanding the source of their funds and source of their wealth. Another very important aspect is record keeping, where where every financial institution strives to maintain accurate and up-to-date records for ready access for regulators. You don't want to get into trouble with regulators when they come into an audit and you don't have records in place. So this becomes very, very important. Another important aspect is reporting suspicious activities. Now, this could be by way of suspicious activity reports or similar reports, depending on the jurisdiction. So continuously monitoring customer relationships and transactions to detect any anomalies, any changes in behavior or risk profile that could indicate any potential money laundering or any other illicit activities becomes very, very key, becomes a very, very key component of, AML and KYC policies as well.
So thanks, Pragya. I think you've given a high-level flavor of, what anti-money laundering is all about, and also what is KYC and why is it so critical, in today's world. These AML practices, I think, as you rightly mentioned, are required wherever there are financial transactions involved, be it banks, be it fintechs, BNPLs, cryptocurrency exchanges, gaming platforms, healthcare, travel platforms, you name it. And, wherever there's financial transactions, you need AML and KYC right there. Now, talking about regulations specifically, so regulations may vary by geographies, but one of the main, body which really puts together the global guidelines for the exact AML regulations across the world, is the Financial Action Task Force. This body plays a pivotal role in fighting money laundering globally. And one of the most recent regulations have been the Anti-Money Laundering Act of 2020 and the Corporate Transparency Act, which was again passed in 2020. There are three main stages of money laundering. There's placement, there's layering, and integration. So as part of placement, really, it's the process in which the illegal funds are introduced into the financial system. So that's the entry point, really. Then moving on to layering, that's the process of moving illegal funds through a series of transactions to disguise the actual source of funds. So they may want to hide the actual source of funds. That's why the layering is done. And then comes integration, which is the process of really returning the funds to the criminal in a manner that it appears to be a legal transaction. So that's what, those are the primary stages of money laundering. And talking about now anti-money laundering practices, these have to be designed in a manner that malpractices are caught at any or all of these stages, which involves constant monitoring of transactions through alerts. Now, any behavior in a particular account that seems different or from the standard, so there may be a standard pattern of transactions that a particular account goes through. And if there is something that is different from the normal transactions, typically an alert is generated. Now, that's how the process of transaction monitoring really goes through. And that's how the anti-money laundering practices are put in place. So these alerts are then investigated mostly by humans to see if that suspicious activity is actually true or whether it's a false positive. Now, depending on what the conclusions of the investigations is, it could be found that there is a genuine suspicious activity happening, in which case the compliance function then looks at reporting those activities out to authorities. For instance, it could be the FinCEN or the NCA for UK. Now, this monitoring really has to be an ongoing activity. So there has to be constant watching out for alerts, checking the alerts, and reporting out any suspicious activity.
Next question is, what are the components of KYC and how do the KYC processes get operationalized?
To form a very comprehensive framework, there are multiple components that collectively help form that comprehensive framework for verifying, the identities of customers, assessing their risk, and preventing financial institutions from being unwittingly involved in any illicit activities. It's important that we understand the specific requirements and processes, which will vary depending on the industry, the jurisdiction, and the type of customers being onboarded. So what's foundational is what we call a CIP, which is a customer identification program. This is really the foundational or the initial step where, any institution collects factual and basic information from a customer, like their demographics, like the name, date of birth, their address, their national ID numbers, like an SSN, passport details, etc. Then, another key component is risk assessment, where, any financial institutions would need to assess the risk associated with all their different types of customers. So a low-risk customer might need minimal ongoing monitoring, while high-risk customers will require more frequent reviews, more stringent checks, and more frequent monitoring as well. Then there's something called CDD, which is customer due diligence, which involves slightly more in-depth investigation into the customer's background and risk profile as well, where you're looking at, understanding the customer's source of funds, their occupation, the nature of business, etc. Then the highest level of check or due diligence is what we call EDD, which is enhanced due diligence. This is even more comprehensive than the others I just mentioned, and it is typically used for your high-risk customers. It involves gathering a lot of additional information and conducting further research to fully understand the customer's profile and their business activities as well. Another aspect, and very, very important, is your ongoing monitoring that involves, keeping an eye on your customer transactions to constantly identify any unusual suspicious activities. And if something seems off, institutions have an obligation to investigate and report it as per, the regulatory requirements that apply to them. What is another key component is sanctions and PEP, which is politically exposed person screening. So financial institutions are again, obligated or required to screen their customers against listed sanctioned individuals, entities, and politically exposed people to ensure that they're not doing business with any, entities that they're not supposed to be doing business with. Then transaction monitoring, another key component, involves monitoring customer transactions in real time to detect patterns of any activity that could be indicative of money laundering, fraud, or any sort of financial crime as well. Training and reporting, right? I think that's a big important aspect too, where, staff members or employees of a financial institution are required to be trained periodically and made to keep abreast with the latest trends in the financial crime world. They need to be, able to recognize red flags and report suspicious activity as well to, their seniors or appropriate authorities as well.
We'll go ahead and round out this episode with one final question. Surekha, I'm going to ask you this one. Just overall, what are some of the main challenges that we're seeing and then the opportunities that you're seeing when it comes to AML and KYC?
Thanks, Jackie, for the question. I think it's a very important question. So, I think one of the main challenges for AML officers today is that money laundering really can occur at any point in the financial system. It could be a small local bank where a transaction is happening, or it could be a multinational corporation where a transaction is happening. It can involve multiple transactions, and these could be across different countries, different jurisdictions, some of them high risk, some of them low risk, making it sometimes very difficult to track and trace these transactions. Also, because of the plethora of transactions that take place every single second across the world, it does become hard to distinguish sometimes between what's legitimate and what's an illicit transaction. So that's the complexity that the compliance teams are really struggling with. And also, as the technology is evolving, bad actors are also becoming increasingly competent. They're becoming smarter. They're devising new methods to outsmart the system, figuring out loopholes, and trying to see how they could make use of loopholes. Now, one of the other big challenges today is the fact that it's a fine balancing act that the fintechs or financial institutions out there need to play it out. Compliance requirements can sometimes be seen as a hindrance to business operations, right? For example, increased due diligence processes, they, especially for high-risk customers, they can result in longer processing times, which may impact customer satisfaction. All of us as customers do not want a long waiting time, and which is why sometimes it's tough for companies to do that fine balancing act between prioritizing compliance or looking at customer experience and maximizing customer experience. Also, now coming to the next part of your question, which talks about what is it that is a big opportunity, and I think one of the biggest opportunity really out there today is the fact that there is technology to leverage. The fact that the transactions have increased, we've also got new technology. We've got a lot more data out there that can help us create models, that can help us create synthetic data, which can be used to model new scenarios and really, look at newer methods to prevent fraud. Now, AI and machine learning, all of us know that they are really redefining the anti-money laundering. Especially the technology can help us generate some rule-based alerts, and then we can have humans intervene to really look at, seeing whether those alerts are true and really coming to final conclusions. So the hybrid model can really work very, very effectively. And so in a nutshell, really, I would say new technology can help improve speed, quality, and efficiency of measures to combat money laundering and terrorist financing. So we need to really go out there and leverage the technology and make the best possible use of it, which will help us overcome some of the challenges that we're currently seeing out there as well.
Jackie, I think that's a wrap on episode 1. Thank you so much to all of our listeners for tuning in today to this episode of CX Plus U. If you enjoyed this episode, please follow us on Spotify to catch the next one. You can also discover much more about TaskUs by visiting our website at www.taskus.com. And please follow us on our social media channels, including LinkedIn, Twitter, Facebook, and Instagram.
Till then, this is Jackie Weinberger and Kyle Bodeglier saying have a ridiculously good day.